This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 15th. Some highlights from today's show. The Fed is signaling what their playbook is. US equities will now stay in a chop zone, and gold is set for a quick drop. Good day traders, welcome. It's Tuesday the 15th of April. Straight into it, looking across the European session. It's a sea of green really. We can see the European equities are staging a pretty good day in terms of what's going on around the world. We can also see, of course, the US equities have staged somewhat of a very similar session, almost identical to what we saw yesterday. Of course, we came in with some gap ups in the US indices. They faded, and of course the market staged a bounce, but then also got faded. So very much a repeat session looking like we have on the cards for today. But with that in mind, let's just get across and talk about some of our first key news coming from the overnight. So our first topic, of course, is all about an ongoing theme, which is the tariff situation. And I think it's important because we're about to find out from the likes of Trump what his thinking is around the tariffs he's going to put on the likes of chips and, of course, pharmaceuticals. Now, this matters a great deal because ultimately, whatever he determines and decides in terms of the absolute tariff amount for these specific sectors, we can start to assume that the key sectors for the US economy are all going to be treated in the same vein. What does this mean? Well, look, Trump wants to onshore the likes of pharma. He wants to onshore the likes of chip making for security reasons. So they are strategically important for the US, and of course, he ultimately needs to apply some form of a tariff that will incentivize them, big companies to, of course, build those industries back home in the United States. Okay, so you can't make the tariff so low that ultimately there's no incentive for big manufacturers to bring back and onshore, but equally, you can't make them too high to the point that he ultimately strangles the US consumer. Okay, so he's got to find that middle ground. Now, whatever he decides, the market's going to take that as his playbook and move with it. In other words, if he comes out and says, look, I'm going to do it at 10%, we're going to align it with the soft tariff that we've put across all countries around the world, the market will take that as a net positive. The market will then effectively think that any strategically important industries are going to get the exact same treatment. Okay, so the point is if he comes out and says 10%, you can kind of start to get an idea ultimately that all strategically important industries are going to get the same sort of tariff around the 10%. Now, what does it do in terms of our gauge? We've been talking about this gauge for some time now. Now, we know coming into this year, US tariffs are around 2.5%. Okay, now we know to be true that that's no longer the case. Okay, current market thinking is that if all the tariffs go ahead currently as planned, we're going to get somewhere around a 25% tariff, a marginal tariff rate in the United States. Okay, and then we've got this 10% tariff that, of course, is being applied across all countries, and everyone technically has this currently because of the 90-day delay. Now, the point is that wherever he tells us that tariff is, if he says 20%, well, we know that ultimately the market's going to start to think that the average US tariff rate is somewhere around this 25%. It's on the higher end, okay? And that's going to make the markets more risk off. Okay. Equally, if he comes out and says, look, it's 10%, that's going to get the market a little bit more confidence that in actual fact, the extreme case of 25% is far less likely. Okay. So all of this works in tandem because if we get a very high rate from him, if he says 20%, ultimately that increases the likelihood of a recession. Markets will respond risk off. Likewise, if he comes out and says 10%, the market's going to think, well, actually, that's not too bad. That's ultimately more or less where the base case was for Wall Street coming into this year. And ultimately we'll start to price risk in a very different way. Okay, so it very much does matter whatever he comes out and decides this week because it's going to set the tone for what comes for every other industry and what comes for every other strategic industry beyond that point. Okay, so very important. He did, of course, tell us that he will be announcing something this week, so keep a close eye on exactly what that number is. The devil is now in the detail. Okay, now currently, like I said, markets are thinking the average tax rate or the tariff rate from the US is around 25%, and of course that was from a starting point of 2.5% this year. And then very importantly, this guy, Gary Shapiro, has gone on to say that ultimately Trump's Friday exclusion on smartphones, computers, and semiconductors was done because what they're starting to realize is that if they are going to impose significant tariffs on certain products, they are ultimately going to hurt the consumer, and they want to avoid that. Okay, so it's very, very important to get sort of a lay of the land right now. And the lay of the land is that the President of the United States is a little bit concerned with the tariffs. Okay, otherwise they wouldn't have backed away. They are concerned about high bond yields. They are concerned about having $6,000 iPhones in the United States. Okay, and what that means is they are backtracking. They are moving away from the worst case scenario. Why does this matter? Well, like I said yesterday, I think we've turned a corner. I think it's as bad as it gets, or it's not going to get much worse than what it currently was as of last week. I suspect we are going to now start to climb that wall of worry because I suspect we are going to start to see more positive sentiment return. Now, that does not mean we're suddenly going to stage a rally back up to record highs. What it does mean is that this idea of moving the S&P back up towards 5,700 over the course of the next couple of days and perhaps weeks is ultimately what I think the base case is. Okay, and that's, I think, the key sort of framing to think about it, is that things are going to get better from here perhaps and not worse. In terms of the Fed, I think this is very crucial. We've now seen this from 2 Fed members, and ultimately they're all starting to say the same thing, which is, look, we take note of the situation in yields and we stand ready. Now, that's not new news. Okay, if you think that's new news, well, you don't really understand the Fed. If you go back to just last year, August, they panicked the moment we got a little bit of weak data and they cut 50 basis points. Okay, the Fed is in the game of buying insurance. They are in the game of always mitigating risk. They do not take risks when it comes to the US economy. Okay, now I think that matters very, very importantly, because for the first time in a while now, this idea of data dependency becomes very, very crucial. What do I mean by that? Well, to frame it in a way, I think we're one bad non-farm payrolls print away from the market pricing in a 50 basis point cut. Okay, in other words, all it takes is one really bad economic print now, and you will see the pricing in the markets very aggressively pricing Fed rate cuts. Okay, despite what you read, despite the fact that the Fed's telling us, look, inflation is going to move up as a result of tariffs, despite the fact that the Fed has told us they are focused on inflation, they do want to get back to target. The reality of the situation is that the Fed said the exact same thing in January, February last year, and the moment we saw a weakness in the labor market, they cut. Okay, they have got a dual mandate. It is, yes, inflation, but it's also full employment. Okay, if we were to see a significant deterioration in the labor market, they will cut, and they will cut aggressively. Why? Because they very much believe they're still in a restrictive policy stance. Okay, so just make sure you're paying attention to all data. We do, of course, get a very important data point tomorrow, which is the US retail sales, and that will be very closely watched, of course, not just by traders, but as well by Fed members. Now, turning to some of our charts, I think one of the key proxy markets. What is a proxy market? A proxy market is ultimately the market that gives you an understanding of the sentiment. I think a key proxy market's Apple. Okay, why? Well, because obviously the news over the weekend was meant to be very positive for Apple. They're effectively getting a form of a let-off, a form of a subsidy, because the US president believes they are strategically important and he doesn't want $6,000 iPhones. Okay, the point is that they are not going to be effectively getting the same tariff rate applied as some of the other industries, and as a result, you would have thought Apple would have staged a really positive day. It opened pretty positive. Okay, we can see it opened around $212, which was a decent $15 gap on the Friday close, but it pretty much sold off the whole day. Okay, now that is not a positive sentiment shift. Okay, that is not a good sign for this stock in general, but also just market sentiment in general. Okay, the fact that Apple pretty much just sold off all day and closed that gap mostly on the day really does suggest that fine, they are going to be let off slightly on the tariff front, but investors are really not in any mood to be sort of sucking up and taking up risk very aggressively. Okay, I think that's the key takeaway. Keep a close eye on Apple. Okay, I think we're most likely going to fill out that gap today. Quite a lot of overlap expected, but should we start to see Apple pare down over the next couple of sessions, perhaps next week, I very much think that's going to lead ultimately the indices back down towards those lows made last week. So keep a close eye on Apple. I think it's a fantastic proxy. Now, with that in mind, I mentioned this last week, this sort of idea of climbing the wall of worry. The reality is that the VIX is getting squashed. It continues to compress itself. Now, of course, we do have the VIX expiry going away tomorrow, and I suspect this sort of contained VIX days. You can see the last 2 days in the VIX have been very, very muted. I mean, we're talking about 5-point ranges relative to 15, 20-point ranges, what we experienced over the course of last week. So I think what's going to happen is we'll get another compressed day of of volatility where perhaps we'll test in below these 30s. I think we'll test probably yesterday's high around 35s, but we'll have this sort of 4-5 point range and perhaps another lower high on yesterday's range. Now, what that means for markets is pretty much they are going to go nowhere fast. Okay, I think we'll get a little bit of an early bid, perhaps. I think we'll get an offer. I think we'll get something for both sides. Okay, I think you can sell the market today. I think you can buy the market, but you will need to, of course, be picking some of those prices. I'll get across to the NASDAQ technicals in a minute. But the key takeaway is until this expiry happens tomorrow, I suspect the VIX is going to stay pretty contained. Once, of course, we get that VIX out of the way, we are then into Thursday, and I do suspect we should see that VIX open up a little bit more. And at that point, I think we'll get a little bit more of a directional play in the equity markets in general. Now, with that in mind, of course, just looking a little bit further out, looking at what the structure looks like in terms of the VIX going forward, I think this matters because it will, again, if you're playing this idea of a wall of worry, you generally do want to see ultimately exactly what you can see on screen, which is in the near term, fine, we have got that elevated VIX level. Of course, tomorrow we've got retail sales, and that's why we've got that little bit of a higher VIX. But beyond that, once we get through that point, we can see that really does start to sort of come down a little bit and then settle down. Again, I think that matters a great deal because what that suggests to us is that, yes, fine, of course, volatility levels are still very, very elevated, and we're still expecting relatively large moves looking out all the way to the end of the month. But in reality, this is a far more conducive environment for taking risk than what we had a week or two ago. Okay, so it's not a case of investors are going to just sort of buy every new high and be regardless of price. They are going to be a little bit more intentional where they're buying the market. But ultimately, the environment is looking a little bit better to ultimately start to buy into any kind of weak selling. Okay, I think that's the key takeaway from the term structure. Now, turning attention to the NASDAQ technicals, I think this chart's quite technically sound and it looks pretty good. We can see we have actually staged already quite a significant rally. I know it hasn't felt like that. I know it kind of came out of nowhere with a single sort of 90-day extension last week. But in reality, we actually have almost retraced 50% of this entire sell-off from the record highs. Does that mean it's time to sell? No, perhaps not. And again, the reason I've got the Fibonacci's drawn here is just to show relative degree of pullback. Okay, it's not that any of these levels matter, it just shows you how deep the pullback is. Okay, now what I do like, I think that 2320, we can see the market did hold very firmly onto that. It did pivot off of that very aggressively. It was very close to that previous record high set in July last year, and of course it has acted a number of times as both support and resistance on the market, and of course it does sort of coincide with that recent swing high as well as just above that 61.8. Now, for me, that is a very obvious point for the market to turn. Do we get there? I don't know. Am I long for that? No, I'm not. The point is, I think, don't be surprised to see it get up there. Don't be surprised to see it make a lower high. Don't be surprised to see anything in these types of conditions. Okay, the point is that technically speaking, we are slowly grinding up. We are slowly climbing that wall of worry. You can see now we've had 1, 2, 3, 4, 5 daily sessions where we've had these higher lows, and likewise, you can see the markets failing to close below a previous day's low. So it's just a constructive environment. It's not a be bullish at any price type environment, but it is an environment that I suspect means we are going to just at least come up and fill that gap around 19,500. Do we go higher? Yes, perhaps we do. And a lot of that will be determined ultimately by the news flow as well as the economic data that comes out. Okay. However, with that in mind, we do have to respect the fact that we do have OPEX this week. And of course, we are going into today's session with a little bit more of a positive gamma environment. Now, again, a positive gamma environment doesn't mean the market's going to go up. In fact, it means quite the opposite. It means the market's going to be quite contained, quite pegged. And we could see that pretty much throughout yesterday's session. There was something for the sellers to do early in the session. We filled the gap to the downside, and then there was something for the buyers to do midway session, and then there was something to do for the sellers late in the session. Okay, it was very much a case of ultimately selling high and buying low. Okay, and I expect an identical session today. Why? Well, because the structure coming from the gamma side of things suggests we are going to be seeing a lot of hedging support coming in at low ticks, and of course we are going to see a lot of overhead resistance coming in as a result of that hedging. So it's hedging on both sides, and what that normally means is a compressed range, and it does definitely mean we want to avoid playing for breakouts. Okay, it's very much a market that's going to stay contained, and unless unless we get some sort of a new news flow today out of the administration, the US administration, I highly doubt we're going to move anywhere fast. Okay, so factor that in because it will, of course, matter. Now, with that in mind, our play of the day is in the gold market. Again, it's a market that was held up very well yesterday from hedging flows. They kept it pegged up at that 32.10 level. We can see how the market really stayed contained there for a couple of hours. Had an early morning staging this morning. I suspect we get back below that 32.20s today, and we are going to see just a little bit of an extension on yesterday's lows. I don't expect fireworks. I don't expect all the buyers to panic and puke at the same time. It's going to be very contained. Okay, I think that's the key takeaway here. This is a market that's very aggressively bought. Don't forget, gold rallied on the bond markets puking last week. In other words, it was being bought as a safe haven asset. Okay, we can see, looking across the board, we do have a little bit more of a risk-on theme the last two sessions, and so I think a little bit of that risk-off pricing in gold is going to come unstuck over the course of today. So keep a close eye on that. I do expect we're going to trade down to that 31.95s today. Test it, perhaps bounce again, do all sorts of shenanigans, but I do think over the next couple of sessions we're just going to drift in down towards that 31.60 level, at which point, fine. I think you can probably buy it there for that next leg higher into record high territory. Okay, but keep in mind, gold's very much overbought. There's only two ways we neutralize that overbought territory. It's through time or ultimately through the market pricing its way back down into a more neutral territory. Okay, that's then, of course, a wrap for today. If there are any questions, do post them in the Discord channel. We are, of course, light on the data front for today. We are going to see quite a number of data points out starting tomorrow morning with UK CPI. And then, of course, the headline print in terms of data this week is going to come from the retail sales tomorrow. Of course, we do have to focus very much on the headlines because any day now we could, of course, see some sort of an extension given to the Chinese. But like I said, anything goes at this point, so we need to keep nimble. All right, any questions, post them in the Discord. Otherwise, good luck out there, manage the risk, go make some money.